Hello everyone and welcome to a very special episode of BNSN on Campus. Today we're at the breeding ground of some of the future leaders of India. We're at none other than IIT Bombay in Mumbai. Joining in today on the show to give us his insights on the outlook for the equity markets as well as his views on the Indian economy, we have with us a very respected face in the markets, and that's Nilesh Shah, who is the founder and CEO of Envision Capital. Thank you so much for joining us today, Nilesh. Does this bring back memories of when you were in school and college as well? Were you a backbencher or did you sit right in front?
Yes, of course. I mean, these are really fond memories that one has. But of course, it's many, many years back when I passed out, I graduated, and I think the world has changed.
Yes.
It's been a big shift, big move away. But it's nice here. It's great to be here with some of the potential leaders of tomorrow, and it's wonderful. It's a wonderful feeling to be here.
And I'm sure it's a wonderful feeling for them to have you in their midst, because we've got a lot of questions for you over the next half hour, Nilesh. I'd like to start off with the first one, and just from the point of view of the youngsters and the youth of today putting money into the stock markets, I find that a lot of them are very apprehensive because of the fear of losing money or high risk. What is the message that you would like to give the young investors of today?
Well, I think the big message, I think, is that the best is yet to come for India. I think that's really the big message. And I think if you really look at the last 25 years or so, clearly India has unleashed a lot of reforms. And I think whenever there is any kind of big change, there's first some kind of a hesitation or reluctance to accept that this reform or this change is going to be for the better. But what we've really seen is that a lot of reforms, a lot of change have really meant good, have meant only better times. And therefore, all that says that, the best is yet to come for India and the Indian equity markets.
Okay, so on that optimistic note, let's get in some questions from the students as well. And I believe you have a question. Go ahead.
Hello, sir. My name is Savat. I'm a BTech third year student. So, I'm a new I'm really new to investing and all. So, what are your advice upon what should I do and what shouldn't I in the while investing?
Yeah, so okay. Like the essential do's and don'ts.
Yeah, absolutely. Yeah, so that's, I think that's a pretty long list, in the sense a lot of the do's and the don'ts. But I think a few things which you need to keep in mind. And I think first of all, keep in mind that what you really, the biggest advantage that you have is time on your side. Okay, you are at a situation where you can afford to be a lot more courageous versus somebody who's probably 10, 20, 30, 40 years even more elder to you. I think that's clearly the first, and so you actually start off with a huge advantage. Okay, number one. Number two is that I think you'll have to be an optimist. I think the first precondition to be an investor is to be optimist. Okay, you can't step onto the playground thinking that what if I lose. Okay, I think you have to get into this with a winner's mindset. Okay, that's the second thing. Third, I think, is to really be very positive about the capabilities of the human community as a whole. And I think whatever we do incrementally, it only benefits. And so to that extent, and the best way to capture that is to be an investor. What really makes difference to any company is basically its management capabilities, the entrepreneurship. And so when you invest, you need to really try and figure out what is this company all about, what really is the management's DNA, is there a growth orientation, and things of that kind. And I think the most important of all is to basically figure out this difference between risk and volatility. Okay, there's a difference between the two. Volatility is when there are fluctuations, okay, but it doesn't mean that you're going to lose capital. Okay, so you could basically be putting in, say, 100 rupees to work, okay, and along this journey, let's assume 100 rupees becomes 200 rupees over, say, 3 to 5 years, okay. In the meantime, that 100 could go to 90, go back 120, come down to 80, go to 150, and all of that. But at the end of 3 years, 5 years, 10 years, if you get to 200, that's fine. So what you have done is you have encountered a lot of volatility, but at the end of it, you have made capital for yourself. You have built wealth for yourself. Okay? Versus that, what is risk? Risk is permanent loss of capital. Risk means that when you put 100 rupees, and at the end of those 3 years, 5 years, 10 years, for some reason or the other, that 100 rupees goes down to 80, 70, 60, 50. Why? Because you probably selected a wrong set of companies, or there were corporate governance issues at that specific company, because of which you had to exit at a loss. Now that is risk. So I think the most important thing, I think, when you step into the world of investing is to really figure out this difference between risk and volatility. Most people say equities is risky. Okay? It's actually not. If you really look at the last 5, 10, 15, 20, 25 years, equities has been perhaps been the best compounder. So I think this is something which probably you need to keep in mind in a very, very significant manner. So that's one. Two is, I think, the long term. The more time you give it, the better it will be. It's like kind of a seed which grows into a plant and then grows into a tree. So I think investing, you cannot kind of get returns on an overnight basis. And along with that comes, and you are a student of technology and you'd understand that, I think it was Albert Einstein who said that compounding is the 8th wonder of the world. So you need to kind of really keep in mind how compounding works. And there cannot be anybody better than all of you here who really understand what compounding is. And I'll give you a small example that if you kind of compound your capital at 25%, yeah, in today's age world of dot-coms and startups and all that, maybe 25% sounds too modest, but whatever it is, if you can compound your capital at 25% for 10 years, in 10 years that grows 10x. 25% for the next 10 years, that 10x becomes 100x. Another 25%, 10 years later, that 100x becomes 1000x. So you guys are at 20. By the time you become 70, yeah, your x can become 100,000x if you can compound this at 25%. And
yeah,
that's the power of compound.
You've really instilled a sense of confidence, I'm sure, into the students. So let's talk about the journey for the equity markets. And yes, you've alluded to the fact that we have seen phenomenal returns. It's one of the best performing asset classes. What's the way forward in terms of direction for the Indian markets? Where do you see it headed, Nilesh?
Well, I think, there are a few things which are really happening with India. And, markets finally are a slave of earnings. Okay, always just keep this in mind. And I think we are very fortunate at this point of time that India is at the cusp of the next level of reforms. And what you're going to see in the next 10 days is the unleashing of the GST, the Common Goods and Services Tax. And this, I think, is the most powerful, the most potent economic reform which is about to happen in the next 25 years, which makes ease of doing business in India. It brings about simplicity. It takes away a lot of time of companies and managements from bothering about day-to-day administrative matters. So I think that's one big thing which is really happening. And this is expected to improve our GDP rate, growth rate, by maybe 100, 200 basis points. So India, which is currently growing at about 7%, could potentially grow at about 8, 9% for a very long period of time just because of this one single reform. A higher economic growth rate means higher earnings, and higher earnings over a period of time leads to more value which gets created. So I think the future is extremely bright. Leave aside the short-term volatility which could happen, number one. Number two, I think the biggest other big powerful thing for our markets which is happening is the financialization of savings. These two things, GST and domestic liquidity, are things which are very structural, which are very enduring, and I think will have a very profound impact on the equity markets over the very long term.
So 10,000 and beyond.
Oh, I think so. I mean, we are already at 9,600, yes. 9,700. That's hardly 3% away from here. My sense is that, it's not a question of whether 10,000 or not. The question is when. And I don't think now that's really the milestone to look forward to. I think we as investors, we as long-term players need to say, it's now when is going to be 20,000 on the Nifty.
So they're going to bear the fruits as well of this momentous move in the markets. We've got some more questions.
Hi, good afternoon, sir. I'm Dipesh, third year undergraduate student of IITB. Sir, I'd like to consider the current scenario of stock market. Like, what advice do you have for the investors who approach IPOs for different kind of raising and all the things like that?
Yeah. So I think, Deepesh, that's a very good question, and I'd keep it. And I think IPOs, in a way, are a subset of the overall markets. Yeah. So I think IPOs as a phenomena is very good. I think as an investor, it makes no difference whether you are investing in an IPO or you're really buying a stock from already existing listed stock. So it's like basically saying is whether I'm going and buying in a sale or I'm buying a fresh. Finally, what determines your purchase decision is basically the price that you are paying for it. Yeah. And I think I come here to a very, very important point that I think as budding entrepreneurs, as budding investors, keep in mind the difference between price and value. As they say that price is what you pay, value is what you get. So when you kind of evaluate any investment opportunity, be it secondary market or be it an IPO, you need to kind of say what is the worth of this company, yeah, and what is the price I'm paying for it. If you find the worth of a company being 100 and you're paying only 80 rupees for it, it's a damn good deal. And you need to keep in mind that some of these IPOs, the numbers at times are in a way could be inflated. I'm not sure whether inflated is the right word, but there's a saying that the bride is always dressed up before the wedding. Yeah. So the IPO is like a wedding. Okay. So you need to kind of keep that in mind. Okay. So that's it. But otherwise, I think IPOs are great, and some of the best wealth creators in a decade actually are companies which IPO'd during that decade. Okay. You have to keep in mind. I mean, Infosys, Bharti, HDFC Bank, some of these companies post their listing in a span of 5 to 10 years, they created phenomenal wealth for investors.
Okay, Nilesh, those are certain pearls of wisdom that we will take note of, and I'm sure all of our viewers are. Tell you what, we'll slip into a quick break right here on the show. Stay with us. Nilesh Shah continues on the other side to give us his outlook on the markets, and we are currently at IIT Bombay in Mumbai. Welcome back. This is BNSN on campus, and we're in IIT Bombay in Mumbai, helping our students go to the head of the class with pearls of wisdom and advice, as well as the outlook for the Indian markets with Nilesh Shah of Envision Capital. And I know investors are really looking at the banking space as well. What's your outlook here, given all the steps that have been taken to lower the NPA stress?
Yeah. So I think clearly as a sector, banking as a sector is clearly the backbone for any economy. I don't think any economy can grow without capital, and it's clearly the bankers who provide the capital, especially the debt capital. And therefore, I think it's very, very important that we have a very sound, robust banking system. I think the problem clearly is more with the state-owned banks. I think the government has done a fantastic job in terms of initiating a lot of reforms, taking a lot of steps. But keep in mind that it's not something on which there's going to be a quick fix solution. It's going to take a lot of time. And therefore, it's quite possible that the state-owned banks will still take some time to kind of get back onto the growth path. I think this, which is a problem for state-owned banks, becomes in a way a sweet spot for private banks. Because if you really look at it, 20 years back, state-owned banks had a 90% market share. That's come down to about 65%. Private sector is now 35%. In the next 5 years or so, or 10 years, maybe it is estimated that the share of private banks will go up to 50%. And I think that provides, so on one hand, you have the state-owned banks who are continuously losing market share because they don't have incremental capital to lend. They are stuck with their problems of past. On the other hand, the private banks are in a sweet spot because their market share is growing. So on one hand, you have the economy itself which is growing, and on the other hand, they are gaining market share at the cost of the state-owned banks, and that itself is a huge opportunity. So I still think that as investors, maybe it's not yet time to invest into state-owned banks, public sector banks, but I think private sector banks offer a fantastic long-term investing opportunity.
Okay, a thumbs up there on the private sector banks. There's been a lot of conjecture really in the telecom space as a whole. So much competition heating up with Rel Jio coming in. What's the outlook on how investors should look at this?
That's a tough space to be in. Very, very tough space, and I think the biggest challenge of telecom is that it's subject to so much of disruption. Okay, today it is 4G, 5 years down the line, we don't know whether it's going to be 5G or 50G. We really don't know, okay? At least I don't know. And maybe it's one of you who will create that 50G or whatever it is. So it's very disruptive, number one. Number two is it's a very regulated business, okay? And third is that it requires deep pockets, okay? So these are the three big challenges which are there for a sector. But otherwise, I think that in a place like India, there are so many other opportunities to kind of really go ahead and invest. Why bother yourself when there are so many obvious risks staring in front of you in the telecom sector?
Yeah, it's a really scary place to be in right now. But some more questions then. Go ahead.
So, I'm Mihir Parekh. I'm an undergraduate student over here. So, I wanted to ask you, how important is it to stay up to date with the government reforms? As we have seen, government activity has a lot of impact on markets. We have seen Sensex boom during the last elections, and it has also happened in the 90s as well. So, how important would you rate it to be up to date with the current government scenario?
I think it's very, very important. It's extremely important. And I think, you know, in a way, governments can, in a way, make or break an opportunity. And so I think, you know, keep this in mind that as an investor, you know, think macros or track macros and act micros. You know, that's very, very important for you. I think it's not just about the kind of problems or challenges, but I think when the government is in reforms phase, it creates a lot of new opportunities. Okay, and I think that's very, very important. Okay, for example, retail, you know, 10 years back, that was not a very big opportunity, but it's because of the government's reforms that retail is becoming a big business. Okay, banking, I mean, 10, 20 years back, it was only state-owned banks, and even computers were not allowed in banks. Okay, now that's changed quite a lot, and because of the use of technology and all of that, we've seen some of the private banks create so much amount of wealth for investors.
You know, Nilesh, in the previous answer, you said that there is also opportunity in many other sectors other than telecom. So where are you seeing opportunity in these markets sector-wise?
So I think if you really look at three kinds of opportunities which are really there, and I think that's, and these are opportunities which are going to be very long-lasting and very enduring. I think one is to do with basically consumption-oriented businesses. Okay, I think India is at a sweet spot. I mean, where do you have 1.2 billion people, a young population with income levels going, per capita incomes improving, the ability to spend, the affordability factor, the access to products, and all of that, I think is changing at a very fast pace. And that itself is a huge, huge opportunity. I think if you kind of go down to tier 2, tier 3 cities, and as they call Bharat, okay, that is really a huge opportunity where, you know, a lot of households have started to spend in a more significant manner, which drives demand for cars, for homes, for appliances, for consumer products. There's also a huge shift in this sector which is happening from unorganized to organized. So the way we would buy our groceries 10 years back and the way we buy it today is very different. This is going to benefit a lot of food companies, a lot of consumer product companies, fast-moving consumer goods, aspirational products, hotels, resorts, aviation, I mean, travel. I think these are the kind of big opportunities which are there, leisure, entertainment, you know, in the entire consumer space. The second big opportunity is going to be in the infrastructure space. India is clearly falling way short of what should be the ideal infrastructure. China spends 7% of its GDP on infrastructure, and China is an economy which is 4 or 5 times the size of India. So we are a $2 trillion economy, China is an 8 or a $10 trillion economy, on which they spend 7% even now on infrastructure, okay, when their infrastructure is perceived or is known to be world class, whereas we spend 5%. So you're going to see a huge increase in spending, and I think this government has done a commendable job of removing a lot of policy hurdles in terms of clearances and all of that. And I think this is very, very positive for infrastructure, and therefore the demand for steel, the demand for cement, the demand for engineering services, the demand for a lot of components, industrial equipment, construction equipment, I think the demand for a whole set of sectors, I think is going to witness a massive boom over the next 5 to 10 years.
Okay, so we've got the consumption space and infrastructure, two sectors that you're
Yes. And the third, of course, what we spoke of earlier was the entire banking and financial services. Keep in mind, we are still an underbanked, underinsured, and an underinvested economy. So I think over the next 10, 20, 30 years, we are going to see a lot of people moving from becoming savers to investors. Yeah, a lot of people from becoming just savers to borrowers. And in the process, you're going to see a strong boom time for a lot of companies which are either a bank or a non-banking finance company or an insurance company or a mutual fund and all of that. So I think these three are going to be very, very powerful sectors.
Okay, taken note of that. Let's get in the last question then from our students. Go ahead.
Hello sir, I'm Arnav Tapan from second year BTech, IIT Bombay. I wanted to ask that actually investment is a big risk, we all know, and can you give us motivational examples of some investors like who has been succeeded in this?
Yeah, or essentially even someone you look up to, your favorite stock market guru maybe.
So well, my favorite is Buffett, okay? And I think he's a favorite not just because he's done well, he's done incredibly well, okay? And the fact that you have an investor who is today amongst the top 10 richest people in the US, okay, I think speaks a lot, okay? Some point of time back, he was probably the second or the third richest person in the world. And then of course, in the last year or so, a lot of the technology companies, founders of technology companies, have kind of moved up the rankings, but nevertheless, he still figures in the top 5, top 10. But I think, leave aside the wealth creation, but I think what he basically has meant in terms of spreading the world of investing, the whole conceptual framework, the knowledge sharing, the dissemination, I think is fantastic. And I think what we have to keep in mind in investing is that, you know, rule number 1 is don't lose money. Rule number 2 is don't forget rule number 1. Yeah, and I think you know that he symbolizes that. Okay, because I think if you lose money, okay, it's always difficult for you to come back in the game. All is not lost. Okay, but finally this is money matter. Okay, it's not about starting a company or a business or an enterprise and closing it and then moving on to the next one. It's finally all about money. So you need to keep in mind, and I think Buffett, in a way, encompasses all of the things that we discussed, which is thinking long term, preserving capital, looking for the big opportunity, being optimistic about the future, the power of compounding. All of that, I think, is incredible. Okay, so I think he clearly, in a way, really symbolizes what I would look forward to as an ideal investor.
Yeah, and he was the investor, the Oracle of Omaha, who spoke to ET Now, the only Indian network as well. But thank you so much, Nilesh, on that note for joining in and helping the young bright minds of today get an insight into the stock markets. I hope you've all taken down notes, but with that, we're completely out of time on the show. Thanks so much for watching.
Find us on Facebook at facebook.com/etnow and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/etnow.